nothing new that you have to learn during that particular conceptual basic concept about project management. Then comes the next chapter, which is about financial decision making. See, the financial decision making, funding, and cost accounting. See, we see that there are two different types of sources of capital that are to be raised. One is from internal source, okay, and the external source. From external source, we see that capital is pooled in from the shareholders. Broadly speaking, there are two sources of capital. One is from the external stores, investors who are the debt holders. Then we see that another source is from the shareholders. So capital is pooled up, the amount is invested into the projects or investments, and then profits are earned. So to the debt holders, there is an obligation to pay the interest amount. So that obligation is met, and the balance of the profits that are available to the equity holders. Again, under equity holders also we have two different types of equity holders. One is preferred equity shareholders, and then ordinary equity shareholders. Preferred equity shareholders also, when profits are available, there is a fixed percentage that is paid to them. Balance of it is available to the ordinary equity shareholders. Decisions can be taken to retain a part of the profit not to be distributed to the ordinary equity shareholders, and only that amount that has to be paid will be paid. Balance of it technically it belongs to the ordinary equity shareholders, but for the moment it is not distributed. Temporarily it is not distributed. It is retained and reinvested so that it can be taken, used for taking up new projects. So that's the concept of retained earnings. They need not look at outside sources to use those funds. It's internally available. Just by not distributing, they have funds available called as retained cash. Then we see that from working capital, because of investing into current assets. So when investment into current assets is made, current assets, when they get converted into cash, that cash is available to meet their obligations. So that is internally arranging for the funds to meet for payment for various things. Externally, until then they've already raised funds from debt holders and equity holders. So that's the initial attraction of initial gathering of capital. But eventually later on also, when they require follow up, also when they require some more capital, they can issue shares to completely new shareholders or to the existing shareholders. So existing shareholders, we call them as rights issue. Or give issue the shares to new shareholders, new investors in the market. So that would be new share issue. Okay. Initially is IPO, later on is FPO. So that is how funds can be raised, that can be used in the business. Then there are sources of debt, as I was explaining to you. There is one major source from which the funds are invested. The funds are raised from debt holders. These are not owners. Okay, so there are external investors who contribute their capital to the business, which we call it as debt capital. So debt capital, debt can be raised. See, they are not owners. They do not have any kind of a claim on the profits that are earned other than their interest amount. So there is a claim only to the extent of interest amount. See, whatever is their obligation, to that extent the obligation would be met. But more over and above that obligation, nothing is paid. So that debt is of three different types. One is long term, then the medium term, and the short term. See, under long term, long term debt can be in the form of debentures or mortgages. So debentures calling in capital amount from the external investors by issuing them debentures. Debentures are a broader term. What we call them is bonds by issuing them. So then funds are raised for a stipulated period of time. As against that, there is a fixed obligation periodically which has to be met. Either it is annually, semi-annually, or whatever is the term period which they decide. Then another type of it is we have it as mortgages. So as against the um, asset as a security which is used, funds can be raised. So those are mortgages. For a medium term period, without acquiring the asset can be still used by taking it on lease basis. Okay, so that is a facility that can be enjoyed leasing. So the assets can be used, and then leasing facility, because of that also some funds can be enjoyed. Then we have taking up the loans from the bank. Bank loans is another opportunity that is available for medium term. Then we see the short term. See, in the short run, see the facilities that are available is the banks also allow them to overdraft more than what is available in the bank balance. So overdrafts is one facility. The other facility is about the payables. Payables is availing the credit facility that is extended by the suppliers. When the suppliers allow them to purchase the material on credit basis. So most of the short-term credit, a major source of short-term credit is trade payables. So these are the different sources of funds that can be availed, or benefits. The benefits in terms of raising funds can be availed from external users, external investors. See, they are not part of the organization, or they are not the owners. Okay. We will take it up in tomorrow's class, the balance of it. It's about what has to be considered when funds are raised. Then we will be looking into, see, these are all already done in part of PM. We have learned about the cost accounting techniques like break-even analysis, decision making, dealing with risk, budgeting, variance analysis. All of that was actually done in PM. So technically, we don't have to learn those things freshly now. We will take it up, okay, in tomorrow's class. And the last topic is about the change management. See how the change has an impact on the organization. Whenever changes, when we discussed about right from the beginning, there were many things, see, on account of technology, digitalization, on account of new techniques that are to be used. See, when they are to be implemented in an organization, there is resistance which comes up. See, how do we manage this resistance that comes up as part of change management is what we will have to look into. It hardly takes half an hour, 30 minutes of time to finish that. So the balance of the time, I will take up any queries that you have. we can look into that. Anything which you want me to repeat also can be done. And then I will do a case study in tomorrow's class, which would be the last class for the session. Okay. Any doubts? Somebody wants to enter the classroom right at this point of time. I don't know why. Anything from your end? Okay then. If there is anything, I will take it up in tomorrow's class. Let's wind up the session here. Okay. Good day.